Welcome to the program. I'm Dr. Dan Krawczyk, a neuroscientist who also studies behavior. I'm particularly interested in value and how we make investments. In this program, called Who You Bought What, we're going to talk to expert investors who've had something go wrong in their process. This is where academic research can really help the investor who's doing rubber meets the road work and just get to the bottom of some of our challenges and also make recommendations about what we can do to improve our process. So today we have an expert investor to talk to, Richard Diamond. Richard, say a few words about your background.
Yes, I'm a principal of Capitalwood Capital Partners. I have more than 25 years of investment experience with a successful track record in management, corporate finance, as well as the development of implementation of strategic and business restructurings.
Okay, Richard, you've got some excellent experience to draw from. On this program, we like to try to take a deep dive into one of those areas that you made a mistake, but you couldn't see it coming. We'll try to diagnose what went on there and get to the bottom of it so we can give you more tips for what you might do in the future. So tell us about a time where one of your investments just didn't work out.
Actually, it's one of my best performing investments in 2020. It's a company called Clearwater Paper Corporation, and it got completely started on the wrong foot. Clearwater Paper Corporation produces and sells private label tissue and bleached paperboard products in the United States and internationally. The company is based in Spokane, Washington. I originally purchased my shares in Clearwater in the spring of 2019 at prices between $17 and $20 per share. I saw two catalysts. One was a new piece of equipment that increased efficiency, but was delayed and 30% over budget. The other was falling raw material prices.
So you had a theory that these two catalysts were going to make an impact on the price. How did it go from there?
Not well. Management begged for patience on their second quarter earnings call in August 2019. However, investors were distrustful and the stock started falling.
Okay, so others were perhaps not seeing what you were seeing. It's getting the timing right in this particular case. Okay, so things are not going well, but you're still believing it's going to happen at this point?
In investing, being right too soon is the same thing as being wrong. The stock started a descent, and when I was down 20%, I sold half my position. I did that for two reasons. One was to take off risk, and secondly, by making it smaller, to reassess if I was wrong and the market was right, or the market was right, or the market was wrong and I was right.
Now, was that a plan that you had in place that if value hit a certain point, you would sell off some of the shares?
Generally speaking, if I'm down 20%, I will sell a position. Just because below 20%, it becomes very difficult to earn back what you've invested.
That's a great tip to mitigate risk, to have a plan in place that you're going to sell off at a numerical value so that you don't have to wonder and get your emotions too involved. Okay, so what happened next?
The stock continued sinking. My position was smaller daily just through market attrition. But in October of 2019, I learned that the company had successfully started the machine and it was working as anticipated. So I waited 30 days to realize my tax loss and started buying again.
Okay, so in this particular case, the timing was off. And I'm reminded of a phenomenon called the curse of knowledge. This is where we have a sound idea, perhaps some catalyst in mind of how a company is going to emerge and gain value. The problem is Wall Street doesn't share your knowledge. And so they weren't moving the value in accordance with those catalysts the way you'd anticipated. And we commonly have this problem. It's a negotiation between what's in our own head and what's out in the world. And we have to fill in those gaps with things from our own mind. And so in this case, you probably had maybe too much knowledge for Wall Street, and the timing didn't follow the way you'd anticipated. Okay, so it sounds good. The catalyst, one of them is working, and what happens next to the value?
Since I started buying at that point, the stock is up 72%. So once the company had materially demonstrated that they overcame their problem versus taking management's word that they would, the price started gaining.
Now, what were your feelings, Richard, at this point in the story?
I really don't have feelings. Stocks don't love you. They're not your friends. And what I found as an investor, the most common mistakes are selling your winners too soon or keeping your losers too long. And what you really want to do is keep your winners because they tend to win over multiple periods, and sell your losers and redeploy your capital into better ideas.
It's really sound advice. That's what we'd all like to be doing. And one of the things that often gets in the way is a phenomenon called loss aversion. Basically hurts more to lose than it does to gain an equivalent amount. You often hear pro athletes describe they actually hate losing more than they love winning. So that's one of the very potent motivators in our lives. We hate to lose. So what can happen in these kind of situations where something is not playing out, it's doing poorly, you can over-focus on it to the exclusion of the things in your portfolio that are doing well. And when we start to get too emotional about something or over-focused on it, we take a risk that we're going to maybe make a mistake simply because it's just occupying too much of what's on our mind. Now, Richard, it sounds like you've had a lot of rules-based policies in play here, which have saved you. So how did it resolve in this situation?
It's probably my largest position through price appreciation. There were other favorable events that occurred that no one could have foreseen, such as COVID-19 and a shortage of toilet paper, which benefited their business. And so I've just let the position ride and focus on what's not working in my portfolio. Every day when I begin at 5 a.m., I look at my most poorly performing positions and I determine, am I right too soon? Did I make a mistake? Or do I think it's a bargain and I want to buy more?
That is so critical. I like the way you have a multi-pronged approach where you kind of look at it as maybe I'm right here, but my timing just isn't playing out correctly. That turned out to be the case here because you had a very sound thesis going into it. Sometimes you're just outright wrong, and it's important to take in the right news and be vigilant, especially on those positions that aren't working out. As long as you can keep your emotions in check, that's actually a great practice. So it sounds like you got an unexpected tailwind, just kind of one of those acts of nature that intervened, and now the position's doing really well.
In investing, you could be right for the right reasons, right for the wrong reasons, wrong for the right reasons, or wrong for the wrong reasons. And you have to accept that you're acting on imperfect knowledge and that sentiment can change very rapidly. But my whole investment process is rules-based. For example, I never buy a full position immediately. I'll buy 25 basis points every other day till I get the position up to a size that I want. And where I realize that I'm wrong, I sell it immediately, because waiting is not going to hope is not a strategy. And I admit that I've been wrong and focus on something else, rather than have a position linger on the hope that someone is more foolish than I am.
Hope is definitely not a strategy. I like that you have these rules in place, and then in some ways they help you, that you don't have to agonize so much and get all emotional about everything, because you've got a plan in place. And often that's a real anchor that people have, just the discipline to carry out that plan rather than flying by the seat of your pants and having to deal with the whims of nature or other people intervening. So, Richard, I wonder if you take a practice of discussing your investments with others who either are interested in the position or perhaps disinterested in it, in order to get their opinion.
Constantly. I speak to peers of mine at other firms, and I not only discuss what's going right, most of the time I discuss what's going wrong to get their input, whether it's too soon, if I've missed something, if my investment process is wrong. And to be successful in investing, it helps if you're intellectually honest. And that idea that anyone from a 25-year-old starting analyst to an other experienced investor can shine light makes, to me, a better process, and it's part of the intellectual excitement of investing.
It's important to talk to other people to get a sense of the sentiment. We also always look for something called confirmation bias. So we always tend to look for evidence that supports our theory. Other people don't share that bias. So it's a really good practice to talk to knowledgeable yet somewhat arm's length other people, just to get a check and balance on your thinking. Because they'll often point out gaps in your knowledge or understanding that you wouldn't have noticed. They kind of provide a different angle lens on the position. So that's an excellent tip as well. So it sounds like, Richard, you have really turned this around by being vigilant, employing rules-based practices, wisely questioning yourself, and bouncing those ideas off of others. These are great behavioral remedies to see your way through a challenging position, not get too emotional to where you make big mistakes. And sometimes there's a silver lining, a light at the end of the tunnel, and happy to hear this one's going really well for you now.
It's really important to be intellectually flexible. I was talking with a peer, and 2020 has been a unique year. And my largest exposure right now is in housing and housing-related stocks. In March, it was de minimis. And my thought in March was, going into a recession, housing prices fall. This has been unique in that housing prices are rising. I think the difference is low interest rates and the fact that we've been underbuilding, along with millennials reaching the age where they're starting families and want to buy homes. In March, I thought housing was going to be down 20 or 30%. Housing prices have done just the opposite, and I've benefited from it. Another aspect of investing that's very dangerous, and I see this happening all the time, is the normalcy bias. And that is, you take whatever conditions are present and you project them forward as if it's going to occur forever. And that as we've seen over the last couple of years, is certainly not the case.
Absolutely. I think we go toward the normalcy position. It's also known as the default effect or the status quo bias, that we tend to think whatever has happened previously is going to continue to happen, or things will play out the way they often have in the past. This is a case of our memories somewhat getting in our way. So being vigilant, taking in news, and constantly talking to smart, relevant other people are good remedies around this. As we wrap up, Richard, do you have one last piece of advice you'd like to tell about your investing successes, how to get there?
People think about investing different from the way they buy paper towels, so to speak. And if suddenly Costco was charging more for paper towels, you would buy fewer paper towels. And if Costco had a great price down 50%, you might stock up on paper towels. Stocks are the same way. When they go into discount, people sell them and they're fearful. And when prices get extreme, they want to buy more because they think it's going to continue to go up. And as long as you're judicious in trying to figure out where you are in a cycle and whether the bargains are true bargains, you'll do very well over time.
Fantastic, Richard. So thank you so much for coming on. You've given us a lot to think about. You talked about the curse of knowledge, not getting ahead of yourself, that sometimes Wall Street can't keep up with you. We've also talked about loss aversion. Beware of paying too much attention to a losing stock. Some remedies, put rules in place and stick to them.
Well, Dan, this has been terrific. I've really enjoyed it. And to anyone who's watching, I'm really serious that I'm open to ideas. If you have anything you want to share with me, I would be honored to look at it. Thank you.
Thank you so much, Richard. And thanks for watching. We'd love to hear your comments, so please feel free to post them on YouTube. I'm the author of Understanding Behavioral Bias, a book on investing biases, trying to help you improve your process. So I'd love to hear about some challenges you had, try and diagnose you, and help you to improve your process. We'll talk to you again next time.